Hi, and welcome to the first video in Big Red Cloud's free 5-part training series, Accountability. Now, keeping an accurate set of accounts is not just a legal obligation, but sound business practice too, because it allows you to monitor what happens to money as it comes into your business from various customers and flows out to pay different suppliers and settle expenses. Now, while accounting for all of these movements of money through your company looks daunting, in reality, we can break it down into 4 actions. We buy, we sell, we pay, or we get paid. And while 2 of these actions, paying and getting paid, are the recording of what physically happens to the money as it comes into and out of our business, the other 2 record what we have committed to do. That is, we have bought something that we are committing to pay for in the future, or we've sold something that someone else has committed to pay us for at a later date. In this video, we're going to look at how the money flows through the company when we make a sale, and the effect that this has on the various accounts involved. When we sell something to a customer, one of 2 things happens. The customer pays us immediately, which is known as a cash sale. It doesn't matter if the customer pays us with cash or a credit card. This is still known as a cash sale, as it refers to the timing, not the method of payment. Or, if we agree that the customer can pay us at a later date, this is known as a credit sale. Again, nothing to do with credit cards, just the timing of the payment. In both cases, we'll issue the customer with an invoice. Now, an invoice must show the following details for legal purposes: the date the invoice was issued, an invoice number that uniquely identifies the invoice, the full name, address, and company registration number of the company supplying the goods and service, the full name and address of the company that's receiving the goods or services, the quantity and description of goods and services supplied, the date on which the goods or services were supplied, the unit price of the goods or services excluding VAT, and the subtotal before VAT is applied, the VAT charged per VAT rate and the rate charged, the total VAT charged, and the VAT number of the person or company supplying the goods or services. We've included a printable download of a sample invoice and an Excel template for you to use if you don't use Big Red Cloud to create your invoices. If you issue an invoice to a customer, the customer owes you a debt and is therefore known as a debtor. Ultimately, we want all of the money that we make from sales to end up as lodgements in our bank account. Therefore, once all debts are paid to us, our sales should equal our lodgements in our bank, assuming for now that we don't make payments from our bank. For simplicity purposes, we're excluding VAT from our examples. This is John. John has just started his company and has made £1,000 in sales. He issued 5 invoices to 5 different customers for £200 each. All of John's customers have settled their debts with John by paying the outstanding invoice amount of £200 each into John's bank account. Therefore, John's sales equal John's bank lodgements like this. But before all of John's customers settled what they owed, John's sales didn't equal his bank account. In fact, before any of them paid, John's sales figures were £1,000 and his bank account was 0. John was owed £1,000 by his debtors. Therefore, if we included his debtors in this picture, we would see that John's sales equal what is owed by his debtors plus what he has in his bank. John keeps a record in his debtors account of exactly how much each customer still owes him. As a customer pays money into John's bank account to settle what he owes John, John records this against the individual customer's account in his overall debtors account, and his sales still equal his debtors plus what he has in the bank, all the way up to when all the debtors have paid him. Now let's imagine that John makes another sale for £200, but this time John's customers pay him in cash. Again, we find that John's numbers don't balance. His sales are now £1,200, but his debtors and bank only total £1,000. In this instance, John will record the £200 cash sale in a cash account. And now the numbers again balance, as John's sales are now the total of the cash account plus the debtor's account, plus the bank lodgements. John keeps the money safe until he lodges it into his bank account. And again, the accounts are not balancing, as his sales are £1,200, but his cash account, plus his debtor's account, plus his bank account, equal £1,400. To bring these back into balance, John records in his cash account that he has moved the £200 into the bank account. And now the accounts are balanced again. This process is the same for businesses that sell products or services. But we know that in order for John to have something to deliver to his customers, he has to source them from his suppliers. In the next video, we're going to look at how we treat the movement of money when we're dealing with John's purchases. Keep a lookout for the next video in your inbox shortly.